completing that. Let me now introduce today's presenters. We're really pleased to have with us today Rahul Dhir, Chief Executive Officer, and Les Wood, Chief Financial Officer of Tullow Oil. Thank you for joining us. And please, would you like to start today's presentation?
Okay, thank you very much, Alex. Good afternoon to everybody. It's a pleasure to be with you all. Les and I are delighted really to have the opportunity. What we'll do is we'll first update you on how the business performed last year. But then we'll take some time and give you an update on how we're delivering on the business plan, also equally importantly, kind of the refinancing that's underway. We'll try and do it in a way that we leave ourselves enough time to answer questions at the end. So let me start with just an overview of the 2020 results. So as you all know, I mean, 2020 was a year of very significant change for us, but we did emerge from that as a stronger and a more focused company. We've outlined a very robust cash generative business plan, and we have a strategy that's focused on our most productive assets. So we feel we're in a good place that way. In terms of operations, despite challenges due to COVID, some operational issues, and also production cuts in Gabon due to OPEC plus constraints, we delivered production that was in line with our expectations. We also started to see some early impact of the operational turnaround that's happening in Ghana with higher gas offtakes, increased water injection, and better facilities uptime. Really, we achieved over 95% across both Jubilee and TEN fields. Elsewhere in Kenya, our license was extended, and we're reassessing the development plan with our joint venture partners. We went through quite a comprehensive rationalization of our exploration portfolio with exits in countries like Comoros and Jamaica. And what we really focused on in exploration now is unlocking value from our existing blocks. What I'm pleased to say is that whilst the results, and Les will talk more about these, were in line with expectations, but also our self-help initiatives delivered in excess of $1 billion of value, including over $700 billion from acquisitions, from disposal, sorry, and cost savings, which are about at a run rate of about $125 million a year net to us. Importantly, also, we have completed all our portfolio management. In fact, today we had our EGM for the sale of Equatorial Guinea, which was passed with substantial support from all of you. So all the shareholders, thank you for that. We announced at our results, very pleased with that, it will be a net zero company. This is in terms of scope 1 and scope 2 emissions by 2030. And that certainly underscores our ongoing commitment to building a sustainable business and also aligning with the objectives of our host governments and communities. You'll remember the strategic plan that we presented at our Capital Markets Day in November. Now that plan delivers over a 10-year time period at a $55 flat oil. It delivers about $4 billion of pre-financing cash flow. So that's cash flow that's available for debt service, debt repayment. And that's really the plan that gave us the confidence to say that we were able to repay all our debt, right? Now, given the hard work that we did in terms of reducing our cost structure, that gives us a lot of leverage to the oil price. So at a $65 oil price, that $4 billion of pre-financing cash flow increases to about $5.5 billion of cash flow. So we certainly have a lot of leverage to the oil price. That's perhaps a good segue maybe to talk about how we're progressing on the business plan. And you'll remember it's got a little over 3 months since we shared the plan. We're very much in execution mode now. So what does that mean? That means we've awarded key contracts like drilling. We've secured JV approvals, that's a joint venture approvals for our budgets. We've completed year-end reserves audit and another successful RBL redetermination. So when you look at all of these together, it strengthens our conviction that this approach will deliver very substantial cash flows and value. And in addition to that, of course, we have several sources of value, including the resource in Kenya and exploration. I'll talk about these later. I think through the reserve audit process, we certainly developed our conviction further that the resource base that's underlying our producing assets is very substantial. We've had 160% of organic reserve replacement in 2020. We're making good progress on things like gas commercialization. I think the recently announced sale of Equatorial Guinea assets and Dussafu also speaks to the quality of the non-operating portfolio. And what it does do is it enables us further to allocate capital to the higher return assets, the core assets in our portfolio. I think the improving commodity environment also helps, and it certainly creates a better, a better backdrop against which we look to unlock value from the significant positions we have in discovered resources, as well as in the emerging basins. So all the innovative work that's being done by the technical teams, I think that certainly helps, and the oil price provides a good backdrop to that. Let me now explain kind of what we're doing this year in 2021 to the delivery of the plan. So this year is obviously a very foundational year, both in terms of delivery of the plan and also as part of our turnaround story. We had a good start in terms of operational performance. And how do we measure that? We look at things like uptime, water injection, gas sales. They've all been either consistent with our expectation or slightly better. We expect the working interest to be in the guidance we'd given on the trading statement in January, which is somewhere between 60 to 66,000 barrels per day. Now, obviously, that's going to get reduced once we have clarity on when the sales in Equatorial Guinea and Gabon complete. What we're excited about, and it's quite important to the growth of the business, is that we will start a multi-year drilling campaign in Ghana next month. In fact, the rig is already in country, and this will help offset the recent declines, and it'll help us start delivering production starting next year. And I've got a few slides in the operational review, I think, which you like, and we'll walk through those. In Suriname, we completed the GVN-1 well. Unfortunately, it was not very successful. We did have some minor oil shows, but that well will be plugged and abandoned, and we'll be looking at what the implications are for the rest of the acreage in Suriname. That doesn't affect the acreage in Guyana, though. I think we're making very good progress in terms of delivery of the cost savings. Les will talk a little bit more about that. And very critically, we're on a journey really to become a very performance-focused organization, and one where there's a big focus on costs and performance. And what we say is it's an organization where every barrel matters and every dollar counts. So that's the kind of mindset you want to have if you want to make money consistently in the oil business. That's quite a fundamental change in our culture and our mindset. Now, so when you can look at this, you said the combination of the strong delivery of the business, de-risking of the business plan, the improved liquidity that we have from all the self-help and the rising prices, all of that really provides support to our refinancing discussions, and Les will cover those in more detail. But let me first share with you what I talked about earlier, which is our net zero commitment. And what we're targeting is the kind of scope 1 and scope 2 emissions. So that's really emissions that are associated with our operations. And we're really looking to achieve net zero through a combination of two things. So one is what is called kind of essentially decarbonization efforts. So these are, modifications to the facilities, things like, for example, in Jubilee, we're looking at debottlenecking of the gas facilities, which will eliminate routine flaring. We'll have some process modifications in TEN, which will, again, eliminate routine flaring, and some additional projects to enhance efficiencies in the facilities and the operations. And that will get us probably about half of the way there in terms of our emissions. What we have left then is we would look to reduce through some nature-based offset programs. And we're fortunate to be in Africa where there is a lot of opportunity to implement these. So after some careful consideration, we discussed with the board and we agreed that we're well placed now to make that commitment to achieve net zero by 2030. I think these projects, nature-based projects, align well with our shared prosperity initiatives, which really focus on achieving socioeconomic development in host communities. So there's a good alignment with what we're trying to do on the net zero side, along with what is near to us, which is the shared prosperity. So let me now hand over to Les. He will talk more about the financial performance and outlook.
Thanks, Rahul. Good afternoon, everybody. It's a pleasure to be able to join you this afternoon and make a short presentation. I'm going to do a little bit on financial highlights, as Rahul said, so a little bit backward looking, and then also I'll finish up with a bit forward looking. I mean, really, over this last year or so, we've put a huge amount of effort into self-help, and that's been really through a number of dimensions, but in particular, what we've done on the way of asset sales. So you saw us secure the money from Uganda last year, and then the transactions that Rahul just mentioned just a moment ago. And with that, we've also embedded a sort of new mindset and approach to cost, which again itself is already paying dividends to the tune of, we've got over 125 million per annum already embedded. And sort of the good news is that we're still working on that and seeing further opportunities for efficiency. And what all of that does is it translates into an improvement in the bottom line. So if you look at free cash flow generation for last year, we were 432 million on back of 355 million in 2019. And as you heard Rahul refer to, if you kind of look at the long-term nature of the business, that's sort of a 4 billion pre-financing cash flow at $55 per barrel. I'm going to show you in a few moments a slide on sort of oil price. And if you just think about that $55 and call it 65, and if you know today we're approaching 70, we're about 68, 69 dollars per barrel today, you can add another 1.5 billion onto that number. So this business can and will generate significant material cash flow. One thing we're very careful of is we have a long run approach to managing our balance sheet from a commodity risk management point of view. So we've been hedging sort of 10 plus years. That's something we do consistently. And if you look at our performance for 2020, that protected and provided $219 million of revenue. So when we had all those low prices earlier in the year, we over the course of the year were able to realize a price of $51 per barrel average for the year, which is significant. As Rahul mentioned, we had, and I'll come on to it in the next slide, on these RBL redeterminations, super important. And then that culminated in the announcement back at the end of February, where we completed the what we call the January redetermination with a debt capacity of 1.7. And I'll talk about the implications of that in a minute. And then I will say we are in constructive discussions with our creditors, and really all the self-help that we've done and external environment on price is providing a positive impetus to those discussions. So next slide, please. So I'm going to talk a little bit about how we're addressing those near-term maturity. And it's really, the left-hand side is a little bit of what I've touched on. So all our cost savings, our deal transactions, a self-funded business, as the whole laid out at the beginning, and this disciplined and cost focus as we really focused on the mindset in the company. And all of that's delivering over $1 billion over the course of 2 years. We've done, in the end, we did 3 redeterminations over the course of the last year, March, September. And what's noteworthy of all of that, those were done under what I would call challenging circumstances. So if those of you can remember back in March when oil price was falling like a stone, it was no mean achievement for the team to be able to get that over the line. And where that leaves us today is with about 900 million of liquidity headroom, which is a good position to be in, given we're in the discussions with our creditors. Discussions, like I say, are constructive. I'm sure there might be one or two questions about that in the end. And we are focused and expecting agreement in the first half of this year. And all of that's underpinned by the discussions that are in the platform that's been created by the business plan. Next slide, please. This is what I refer to by, the changing external environment. This is a slide I showed at Capital Markets Day, first of all, and then we provided an update just at the recent results. I think the left-hand side of the chart, everybody would recognize, which was what happened. Well, two things really happened. One was with OPEC adjusting its production rates, and then everything that happened with COVID. And of course, we've seen with the advent of the vaccine, and also with OPEC providing tighter controls on production and the resultant demand, as we've seen a dramatic improvement both in the short term and the medium term outlook for oil price. And for those that have seen this graph before, you would have noted that the blue shaded area was a little bit further down, and our numbers, while towards the bottom end, was a little bit more in the middle. And we would have described that as conservative. And now, as you can see, we're very much on a long-term price, which is what our numbers are modelled on at $55. We're very much at the bottom end. And if you look at the near-term price in 2021, as I said, we're at $68, $69 per barrel. And we set our business plan this year, assuming the oil price was going to be $45 per barrel. So far this year, we've realised 55 in the month of January, and we've realised 62 in the month of February. So really, we've got off to a good start. And as Rahul said in his opening remarks, focusing on cost and focusing on production allows you to take advantage of these higher oil prices. So it's super, super important. Next slide, please. So this is kind of a bit of a continuation of where I've been talking about on costs. There's really two important parts to this chart. The first on the left, which we've talked at some time, and this is a good illustration of the low cost of our Ghana assets. You've got Jubilee on the left, TEN on the right, and TEN we believe is still, we've got here, the shaded area at the top, because we believe there's further sort of some structural issues that we can take and address to actually reduce that cost overall. So we've got low cost assets. Maintaining that low cost allows us to take advantage of the oil price rise. Then on the right hand side, we've got a chart which, again, those of you that might have looked at the capital markets, they might have seen before, but it's a very important chart because it lays out, there's over sort of 60 different investment opportunities. We're not yet complete on all of that, but what we do is we have a very attractive portfolio. So you can see here the average line being in excess of 80%, and then you can see how that rises to well over 100%, I think 130% by the time you get to $65 per barrel. And what's just as important as the upside is that we've got very good protection to the downside. So what that does is that gives us confidence to invest. And if you look at the forward program, we're anticipating investing about 2.1 billion net cost in these assets, with about 75% of that being focused on oil. So really and Rahul talked about this when we had our capital markets day, there's not many times you get the opportunity where you've already invested a huge amount of money in your your infrastructure. So we've got all the FPSOs there, we've got all the subsea infrastructure, and now we're able to take advantage of the resource that we've got in the ground, which is considerable. Next slide, please. So really, this is the final slide in my section before I hand back to Rahul. This is our 2021 guidance, the 60 to 66,000 that Rahul laid out. It's in line with what we gave in our trading update back at the beginning of January. We've tightened our forecast on CapEx. That's once we finalised our work programme and budget with our joint venture partners. It's a guidance that lays out at $50 per barrel, $500 million of operating cash flow, and about $0.2 billion of pre-financing cash flow. What's important to recognise that for every $10 per barrel movement in oil price into the positive, that's about another 100 million of pre-financing cash flow. So we've got a business that, as we focus on every barrel and every dollar, that's very much leveraged to oil price, which is a good thing to be in the current environment. And then on the right-hand side, you can see the production breakdown for the year, which, as Rahul said, we will adjust in due course once we've completed the transaction. So really, in summary, we've had a strong 2020. We've had a good start to 2021, and we're well set up to take advantage of the current increase in oil price. So with that, Rahul, I'll hand back to you.
Okay, thank you, Les. And I'll start just with the health and safety, because that's important for our operations and business. So COVID was and continues to be an important factor. But what I wanted to give you assurance is we've managed it well. There's good cooperation with the government of Ghana. We've had a couple of small outbreaks, but it hasn't affected production. And fortunately, people who were impacted are safe. But it's an ongoing thing, and I wouldn't underestimate the complexity. But again, just to give you the assurance that that's something that we're quite focused on. In terms of safety, we focus a lot on our performance metrics, benchmarking ourselves against industry averages. Last year, the numbers went up. These are recordable incidents, which are basically measured relative to the industry. And also we look at it relative to our past performance. Specifically, the incidents were driven by about 8 injuries across the sites. Fortunately, they were not in our core operations in Ghana or in Kenya, but nevertheless, we take this pretty seriously. And again, we want to learn from these, and there's a lot of focus from myself down to all the way to the operating organizations to make sure that we run safe operations and nobody on our operations get hurt. I wanted to talk to you about our resources and reserves, because this is quite fundamental to the longer term business of the company. So first, it's a large resource base. On the chart on the left, you see the 2P reserves. That's what we really focus on. That's what we discuss with our banks as well. That number has gone up 260 million barrels less relative to 243 last year. And if you include the production we replaced, is 160% of reserve replacement. Where did this reserve replacement come from? Really, it was twofold. So one is because of the business plan. As a consequence of the business plan, we accelerated reserves, because if you remember the business plan, we're investing consistently across both Jubilee and TEN, and one of the consequences of that is that we're looking to accelerate reserves. So, for example, we added 45 million barrels to the 2P reserve, and that was partly due to that. And then also we had updated views in Simba, which is in the non-operated portfolio in Gabon, and also in Cote d'Ivoire. When you look at the 2C resource base, and I'll talk about Jubilee and TEN in particular. So Jubilee, when you look at the 2P and the 2C together, we are now looking at about a recovery factor of 45%, which is slightly higher than where we were at the Capital Markets Day. And the point really is that Jubilee is a big field. It's got about 1.8 billion barrels of oil in place. And while we've been at it for a number of years, we've only recovered 17% of the oil. So there is a long ways to go. And that's really what gives us the confidence to start drilling. And that's really what underpins a lot of the growth of the company. And similarly, TEN has an even larger upside potential, because it's a slightly smaller field, so 1.1 billion barrels of oil in place. But there we've only recovered about 9% of the oil. Now, TEN has a larger contingent reserve base, resource base, sorry, relative to Jubilee. And that also gives you a sense of that Jubilee gives you more near-term production, and TEN is going to drive our longer-term production growth. And so TEN, again, from a recovery point of view, our current estimates, when you add up the 2P and the 2C, is about a 30% recovery. But we think when we look at it technically, that number should be comparable to where Jubilee is currently, which is a 45, perhaps even 50% recovery. So a lot more upside across both of these assets. If I move on to really a little bit of an explanation and to give you some forward perspective on production growth. So on this chart, you see historic production from Jubilee, and the colors really represent production vintages. So production starting in 2010 and 2011 and so on and so forth. So we've tried to give you a sense of that. Now, two things really strike me when I look at this chart. One is that, as you would expect, these fields or the wells will decline when they're left on their own. So you really need to drill on a consistent basis in order to sustain production. The second thing that really strikes you is that since 2013, we've really not had a consistent drilling program in Jubilee. So when we had consistent drilling program, production was increasing. When we didn't have consistent drilling program, production was decreasing. The other thing that you see here is that historically, Jubilee has been marred by a lot of operational issues and facilities issues. You have three dips, 2016, 18, and 20, which all correspond to the first two, to the repair of a very large piece of kit, which was the turret at the Jubilee FPSO, the failure in 2016, the repair and stabilization in 2018. And then in 2019, we were facing high water cut and high gas oil ratios. So those have been, and again, historically, if you look at the table on the right, we've had below 90% uptime, not a lot of gas exports, inconsistent water injection. The good news is we're fixing all of that. We had much better performance in 2020. We're continuing that performance this year with 95+% uptime, with consistent gas exports and very high water injection. And the exciting thing in TEN is that you have, because like I said, you only produce 17% of the oil, so you've got a deep inventory of opportunities of nearly 25 wells, producers and water injectors, and I'll explain shortly to you how water injectors also contribute to production. If you look at the story in TEN, TEN is of course a very reliable FPSO. It's a newer FPSO compared to the K&K, which is the FPSO at Jubilee. TEN also has a much larger contingent resource base, if you remember. So we're not constrained in TEN on capacity at all. And so that gives you a lot of opportunity to add resources, reserves, and production. Now, historically, what happened in TEN is that you had two big factors that impacted. One is that you had a border dispute with Côte d'Ivoire, so that only got resolved in 2017. That meant that there was a delay to the start of drilling. The second thing, for those of you who've known the company for a while, is that there was real disappointment on Enyenra. So TEN has a couple of different kind of structures, if you will. There is Enyenra and there is Ntomme. Ntomme is a lot similar to Jubilee from a geological perspective. Enyenra is different and is more complex. And now we've had, since the disappointments in Enyenra, we've shot 4D seismic, which gives us a better understanding of the reservoir and the resource in Enyenra. But we believe the bulk of the development and the resource is going to be focused on Ntomme as we go forward. Now, here too, we have a pretty large inventory of producers, water injectors, and gas injectors. So across both Jubilee and TEN, you have, which is very unique actually, you have almost more than a 50 well inventory of opportunity, and that's really what drives the confidence in terms of restoring production growth. And so maybe it's a good time for me to then move to what we are doing in 2021. And that gives you some color because we have a very well-defined and a low-risk drilling program. But what I'll do is I'll illustrate you some very specific things. So at the top of the chart is on the left is a picture of TEN. So you can see Anyendra, which is the kind of snaky structure on the left. And then you have the Ntomme. And on this chart, the dark greens represent parts of the fields that are developed. The light greens are yet to be developed. So you can see a very large light green patch on TEN, and the red is the gas. Okay, so that just gives you the context. Now, what I've done in the right, on the top right, is a slice. It's a cross section, almost like a slice of cake. And the blue is the water. The green, so this is a cross section through the reservoir, through the rocks. The green is the oil, and the red is the gas. And the two black lines labeled P are producers, and the black line, which is labeled GI with the square, that's a gas injector. So what we have is these two producers. They've been producing on their own, and that's including the NT09, which we drilled last year, without any support. So they've just been producing on a natural energy. And they've together declined by over 20,000 barrels of oil per day, largely due to pressure depletion. So the plan is to drill, as part of the 21 program, a gas injector well on the top right, and that will help reinstate production by repressurizing the oil reservoir. And that what it does is that accelerates reserves, and it adds some new reserves as well. Now on Jubilee, which is on the bottom left, again, similar nomenclature. You've got the dark green part, which is developed, and then the eastern part of the field is light green. That is a big focus of kind of the next phase of development. You'll hear me talk about Jubilee Southeast and Northeast, so that's illustrated there. The 21 program is targeted to, we have 2 oil producers and 1 water injector. So I'm just going to illustrate to you one of the oil producers. So in the cross section, again, in the middle, you've got the blue is the water, and then the green is the oil. So what you see is there is an old producer, which is the P in the middle, and that has now been largely kind of watered out, and that's depleted. That was a fantastic well. It produced probably, I don't know, 20+ million barrels of oil. We're looking to drill this new well, which is labeled in the P with the square around it, into an area which is up dip. So it's not a very scientific term. It's called the attic oil. So that's a well-defined opportunity. And then on the right, the little cross section that you see, you have a producer P, which is again been producing similar to what we discussed in the case of the 2 Ntomme producers. In the case of TEN, it's been producing on natural depletion, and that's there again. The production has declined almost by about 12,000 barrels a day because of lack of pressure support. So we look to drill the water injector again this year, so we can start injecting water, and that'll support production, and again that'll help restore production in this. Let me just then turn to the next page and talk about just practically how we're looking to to deliver these wells. So as I said earlier, we're starting a multi-year multi-well drilling program. The immersed venturer is in country. What we have done is we took some good lessons. So one of the things I did when I joined was to look at all the wells that we've drilled historically in both Jubilee and take lessons learned from that, which means that you simplify perhaps the well designs, you plan on a more integrated basis, you look at how you're contracting, and all that has led to cost reductions, probably about 20-30% from what we were drilling before. So that's good news. We typically targeting about 70 days to drill and complete a well, so you should expect us to drill 4 to 5 wells a year. And each one of the, just because of what I explained to you in the previous slide, we expect the Jubilee producers to add about 8,000 barrels of oil per day. The water injector will add about, again, another 8,000 barrels of water per day as it pressurizes and starts pushing more oil out from the producer that it's connected to. And the gas injector would probably add about 5,000 barrels a day. And with the 1 rig, we would expect to sustain the same sort of program. In fact, we're discussing with the joint venture partners as to what the program looks like for 2022. And I've just given you an illustration of what it could be. We haven't quite agreed what the mix is. But certainly when you look at this and you say, if you were drilling over the next 18 months, 5 wells, let's say in Jubilee and a couple in TEN, you'll be able to bring production back in Jubilee to levels that we saw last year, and 10 you'd certainly be able to stabilize production levels in 22 to the same levels as we have this year. So that's kind of the idea. And given the recovery in the commodity prices, and also given the the deep inventory of opportunity, we're looking to start a second rig as well, and that's discussions that's ongoing with the JV. Let me quickly now turn to the non-operated assets. These are some ways simple. They've delivered over the past 5 years, and we look, stable production somewhere between 22 to 25 million barrels per day. We'd expect this to continue as we go forward. Of course, that base level is going to be reduced by about 6,000 barrels a day, reflecting the divestment. We also have here some high-value development projects which are being matured for 2022. For example, in Cote d'Ivoire with the Espoir field, and also in Gabon with the Simba expansion project. So again, similar story a little bit as to Ghana, but on a smaller scale. But you certainly have the ability to continue to invest and sustain production here as well. Let me then move on to our kind of non-producing assets, where really 2020 has been, a year of a lot of transformation. Of course, we sold Uganda. We rationalized our exploration portfolio. We got out of 11 blocks and two countries. So what we have left is a very focused portfolio, a lot of focus in Kenya on reorganizing and rephasing and rescoping the project so we can make it more robust at lower oil prices. I don't have a lot more to add to that at this stage, but we should be able to give a better update in the second half of the year. With respect to the exploration portfolio, the main message I wanted to give you is that there is a lot of focus right now, the team, to better understand the prospectivity. And then I think we're in a much better position to see how we can unlock value from that. And I commented earlier on the Suriname well. Obviously, it was disappointing, but again, it was a well that was a commitment well, and it was frontier and high risk. So that's the story there. Let me move on just to conclude so we can get to some questions. I think the point really is that hopefully, again, those of you who've been following us for a while, if you go to the next slide, please, our purpose and strategy are very clear. We've got a 10-year plan. Not often do you have this kind of clarity, but we do. And it's a consequence of the resource base that we have. So the focus we have is now on delivery. We've had a good start to the year. What you see happening is a consequence of a low cost asset base, so that gives you leverage to the oil price. You couple that with the self-help, which has delivered some real value. We're identifying upside opportunities in our non-producing assets, and all this positions us well, not just for the refinancing thing, but I think critically it enables us to build this company which is going to be successful, and it's going to create value in any price environment. So with that, really, Les and I here, we're delighted to answer questions. So Alex, over to you.
Rahul, Les, thank you very much for that. We've obviously had a lot of questions come through, and we're going to try and do our best to cover as many as we can. I'm going to start with one that came in ahead of time, quite specific. It's probably aimed at you, Les, here. On February the 5th, Tullow Oil was put on credit watch, negative by S&P, over concerns about an impending bond maturity that may give rise to a distressed exchange offer. Can you rule out a distressed exchange offer?
No, thank you. That's a good question. And really it's a reflection, at least the rating agency's approach, based on what's in the public domain about the ongoing financing discussions. And also in a way what we've said ourselves. So we've put in our results that we have this material uncertainty with respect to our going concern. And really that's all to do with, it's not a cash flow problem from the business, given all the things that both myself and Rahul have laid out, but really it's as a result of the near-term debt maturity, the convertible due in the middle of the year, and then the high yield due in April of next year. And the markets just has uncertainty as to how we're going to deal with those. And with that uncertainty, what the rating agency is saying that that's a possible outcome. Now, that's not a view that we share. If you look at where the business is sitting today, we're on, as I said earlier, we're about 900 million of liquidity in an improving environment. So really, we have a business plan that we laid out that we don't believe or see needs equity. Therefore, it's just a view that they're expressing because they're uncertain as to how the outcome will be. Now, we've got these ongoing discussions. We've got ourselves have got advisors, the 21s have got advisors, and the 22s have got advisors, and we are in constructive discussions. So they've laid that out, but that's not the view that we share.
Okay, thank you for that. Let's go on to some of these other questions. What was the outcome of the meeting with the Ghanaian Revenue Authority last week? Will the outstanding tax bill of over $300 million need to be repaid? Anadarko appears to have paid already.
I think, let me give you kind of my view, and then Les can add to that. I think, well, firstly, you know, our position on those tax disputes is very clear, which is that the company does not owe that. That's the position. I think the second is, you know, for those of you who worked in emerging markets or invested in emerging markets, these are not uncommon. I guess, frankly, it's not just emerging markets. Probably even in the UK, these, you know, the tax disputes are not uncommon. I think that the method generally is to be respectful, to engage with the government, put forward your views, and in time these do get resolved. That's been our experience, particularly if you have a robust position. So whilst I mean I think that one meeting here and there isn't necessarily going to resolve this, we're very confident of our position, but we'll continue to engage with the government in a constructive manner, and it will take some time. That's right. And I'm not aware, Les, I don't know, maybe if you are, if Anadarko has settled, but I certainly was not aware of that.
No, I would only add two things, I think. One is from a practical point of view, not all of the attendees from the government actually joined last week, so the meeting was deferred. So actually we're meeting this week. But then second, again, like Rahul, I'm not aware that, and we might not be aware that anything on the Oxy or the Anadarko side. That's really for them to deal with.
Okay, great. Question here, what are the examples of the nature projects that you're looking into with regards to hitting your net zero targets?
So, you know, we haven't kind of specifically zeroed in on projects, but I think certainly I'll give you a flavor for it, because what we are seeing is there is a tremendous opportunity in the countries of our operations, in Africa in general, I would say, of projects that involve reforestation, preventing deforestation, those sorts of projects. A lot of these projects have a very large social impact. There is a very large community engagement. So it fits in really well with our shared prosperity agenda. Also, you know, quite frankly, as we've looked at a number of sort of things that are emerging, we feel that we as Tullow, given the relationships that we have in Africa, given our commitment to shared prosperity, are pretty well placed to work closely with agencies and governments to deliver that. So that's kind of the broad thinking that we have. But as we identify the projects and stuff, I'm sure we'll share the details.
Okay, I'm going to ask now a couple of questions linked on to debt and the overall picture. So the first one is sort of a big picture question, which says, given the cash producing or cash positive producing assets, what's the appropriate level of debt for the company? And then I'll just mention the sort of two follow-up questions, and a couple of people have asked this, so they're clearly interested in this area. Have the reserve-based lending banks signed off on the liquidity forecasts and the tests there? And why is there a need to negotiate with existing bondholders, and why not simply refinance the 2021 convertible and the 2022 bond with a new bond stroke convertible?
So all good questions. I'll let Les answer them in detail, but just wanted to kind of share my perspective, which is based on the plan that we have, and certainly the oil prices help with that. We were looking at deleveraging the business to about $1 billion level by 2025, and that certainly felt very much in a kind of comfort zone to us. But Les can give you more commentary on that. I think with the higher oil price, that accelerates. So that's kind of one point. So never, even at a lower oil price, we were ever in doubt about the ability of the business to repay the debt. I think the problem we've been consistently trying to solve for is essentially a mismatching of the cash flows and the debt maturities, so which in other words is a refinancing problem. And that's kind of the third question, I think, refers to that. And the discussions that Les described were all sort of aimed at achieving that refinancing. And obviously you consider a broad toolkit of options as you look at the refinancing. But I'll let Les give you more color.
Yeah, maybe that's right, Rahul. Maybe a couple of other things to say. Certainly, as Rahul laid out there on if you look at the business plan that we laid out, that 10-year plan, on the $55 price, we were going to get ourselves in that $1 to $1.5 billion range in the middle of the decade, in the 2025 timeframe. I laid out earlier, if you get a $10 improvement in price, and today we're at 68, you suddenly generate another $1.5 billion. So over that 10-year period, so you can make huge strides in bringing that whole thing forward. Mr. What's acceptable, certainly with the assets that we have today, we'd like to get that towards the lower end of that $1 to $1.5 billion dollar, and we can get there in that sort of 25 quicker if prices are higher. Let's do well. So why are we talking to the bondholders and to the banks? Well, if you set yourself back just to the capital markets day back in November, it's exactly as Rahul laid out. This is not a cash flow problem per se. It's a near-term debt maturity. What was in front of us, still in front of us, was the 300 and 650. Some things have changed, so it's a good question. We've delivered for the self-helps, we've delivered for the asset sales, and also we've seen an improvement in oil price. But when we set back, and we're not precisely, from my memory, what the oil price would have been back then, it certainly wasn't at $68 per barrel. My guess it would be in the 40s to low 40s. So therefore, when you look at that sort of environment, therefore we needed to address the maturities that were in front. And that was the reason for engaging our bondholders. I think for those of you that have looked at the sort of going concern that we laid out as a result, you would have noticed that we said that, we're considering sort of all options. And I think what happens is, with the oil price where it is, continued self-help, it just opens up different avenues. So all I would say is that we are in constructive discussions. The oil price does afford different avenues, and the market for this sort of thing is much more open in the industry generally. So I think we're well positioned with a good, strong financial foundation to address it. So that's what I just add to what Rahul said.
Just one further question on this area. You may be able to answer this, you may not, but based on your
I think you also had a question about the group-wide funding, which is still subject to, we're still waiting for feedback from the banks.
Yeah. So based on your pre-financing cash flow projections for 2021, this is the question is saying, I estimate you'll reduce net debt by circa $200 million at $70 a barrel. Have you done a similar projection? And if so, could you give any net debt guidance for the end of 2021?
So I wouldn't guide net debt, but what I would do is someone on the call is doing the arithmetic. So that's right. So if we set out 200 pre-financing, and our interest costs are give or take 200, so at $50 per barrel. What we did say was for every $10 per barrel increment, you get 100 million. So you add, today we're at 70, so you got that for the year, and we've had a good start. You can do the arithmetic. And also, with the closure of the transactions in AG and Dussafu, net over the year, that's 100 million. So with a good start that we've made and continued sustained oil prices, we've got a chance to reduce our debt appreciably over the course of the year.
Okay. A question now on your reserves. What are the current proven developed oil reserves at the TEN field? Cosmos reporting suggests 1P10 reserves of 108 million barrels, of which only 40 million barrels are proved developed.
So I'm afraid we talk to Cosmos a lot, and they report under a US methodology, so there is a different approach to that. So we report under the 2P reserves, and they do a US style. So I can't really comment on how Cosmos do it. But I think what I want to draw your attention to is that when you look at 10, the ratio of the 2C to the 2P is much higher relative to Jubilee. Okay. And what that tells you, so you couple that with the fact that only 9% of the reserves have been produced, and of course 10 came on stream later, just gives you a sense that 10 is kind of earlier stage of maturity. And then it fits in with what I was saying, that, when I look at a 10-year view, sorry for the pun, but the early part of the decade is kind of Jubilee heavy development. The later part of the decade is kind of a 10 heavy development. That's sort of how it fits in. And then that's also ties in with what I was saying, which is the 21 program, for example, has got of the 4 wells, 3 is Jubilee, 1 is 10. 22, again, you'll see a kind of Jubilee heavy program. So that's kind of the picture that I wanted you to take away. But it's the mix of the reserves and resources in 10 is more contingent versus 2P.
Okay. Follow-on question on to Ghana. So you're focusing a lot of capex on Ghana on the assumption that the additional wells will deliver the enhanced production that you predict. Given the historic underperformance of the reservoir, are there any operational and financial risks arising from the new wells not delivering the extra production that you predict? And are you concentrating too much risk in Ghana?
It's a good question, and I'll direct. That's why I wanted to kind of give you the historic perspective. So what I would submit is that for both Jubilee and 10, the resource base and the reserves are quite well understood. We had a challenge in 10 with Enyendra, but I think that is understood, and Enyendra is a smaller part of the future. The reservoirs themselves are quite good. They're high porosity, high permeability. The wells produce at phenomenal rates. So the subsurface in the way has never been the issue. If you look at Jubilee in particular, and we look at the history, as I said, 2 things kind of stand out. One is lack of consistent drilling. So since 2013, we've drilled maybe 5 producers and 3 water injectors, and that's not enough. So if you look at the vintage of the wells that we're producing with today, and we're dealing with high gas oil ratios and high water cuts and things like that, that's a very simple consequence of not having drilled enough producers or water injectors in the past, right? So there's nothing wrong with the resource itself. And of course, the other issue has been of productivity and operating efficiency. So if you took Jubilee in 2019, I think we had, I think, or even prior to that, we kind of like mid-80s uptime. Last year, we had a 96% uptime. If you're adding, say, 6 or 7% uptime on an 80,000 barrel a day field, I mean, that's 5,000-6,000 barrels a day of free oil. I mean, that makes a tremendous impact to the profitability of the asset. So I think the focus, therefore, is to say you're drilling consistently, you're focusing on operational turnaround, and that's why you've heard me talk a lot about, how do we enhance the reliability of the plant, making sure we're investing in asset integrity, making sure that we're doing the gas offtakes water injection, all of that stuff.
Okay. Sort of an operational OPEX question here. Are your lease costs for TEN for the FPSO included in your OPEX numbers for TEN? What is the day rate annual cost going forward?
Les, you want to do that?
No, they're on top, and it costs us just over 100 million a year net for the FPSO. That's well described in our results numbers.
Okay. Given the rebound in the oil price, can you give us some color on the strategic value of assets in Africa relative to other parts of the world?
I think that's a difficult one. I think that what I would say to you, maybe just specific to kind of 2 points I'll make to you. One is that I think there remains a lot of interest for assets in Africa. I think that's certainly evidenced by the fact that last year, in a very, very difficult oil price environment, we were able to get a reasonable price for the Uganda assets. I think in a very, very difficult price environment, we were able to get a very decent price for both Equatorial Guinea and Dussafu assets. So I think that speaks both to the quality of the assets, but also speaks to the interest, in these assets. I think specific to our portfolio, what I'm very proud of, and I think the shareholders should be very pleased with, is that these are very structurally advantaged assets. What do I mean by that? These are big resources, so your risk of finding new oil is not there. You have a lot of the infrastructure is already there. What does that mean? That means that the returns on new investments is going to be very high. You've got to focus on costs. That means your margins are very high, right? So what we're trying to design is a Tullow as a company that doesn't need high oil prices to make money on a sustained basis. And I think that's where we've been quite successful. The work that we've done in terms of taking the G&A costs, OPEX out. I think all of that makes it, quite a compelling portfolio of really what I call kind of structurally advantaged assets.
Okay. We've probably got time for just a couple more questions, and apologies that we haven't
Sure.
been able to get through all the questions just because there have been so many coming in. But anyway, I'll try and get through just 2 more before we finish. And the first one is the news on Suriname good or bad news? Could you give us a bit more detail here?
Well, what I explained to my chair today was, I said, look, this was a high risk well, and that means the chances not working is very high. It was a commitment well, so we didn't have a choice. We had to drill it. The team did a good job in terms of reducing our financial exposure. So we had a 50% working interest, but we paid for about 36%. So that was all good. But having said that, look, when you're drilling these, and I've done this for a long time, when you're drilling these wells, you're always hoping that no matter how risky it is, you're always hoping that it's going to come in. So I'll be honest with you. I mean, I'm disappointed in the sense that, you'd have liked for it to come in, but it's fine. I mean, that's kind of what was the kind of likely sort of, it's a high risk opportunity. That's not surprising. I think we need to think through pretty carefully what the data tells us about the rest of the acreage. It doesn't affect, by the way, the potential or our understanding of the Guyana blocks.
Okay. And then a last question is it sort of adds in questions from 3 or 4 different people. So it sounds like it's something on people's minds, which is, would you consider, or are you considering, issuing equity to pay down the debt, or do you think the improvements in the oil price will lead you to generating sufficient free cash flow internally that's an option that you don't need to consider?
I think we've been very consistent, Alex, that even at the capital markets day when prices were much lower, that the business plan did not need any equity. This is a self-funded plan, and the pain that we went through with the cost savings, the massive sort of organization restructuring, the self-help, all of that was designed to make the business plan be self-funded. I think so. We're very confident the business plan is self-funded. It doesn't need the equity. I think as Les said, with rising oil prices, obviously our ability to pay down debt increases. It creates more options in terms of refinancing. So we've always approached the debt problem as a refinancing problem.
Brilliant. Look, Rahul, Les, thank you very much for presenting. Thank you very much for answering all those questions. And again, I say to attendees, apologies, we haven't been able to cover all the questions, but we've just unfortunately run out of time. As you leave today's webinar, you will come to a short survey. It'd be really appreciated if you just send a couple of moments just completing that survey. And if you've got any queries that you'd like to follow up on, you can send them to info@yellowstoneadvisory.com. Just like to mention two things before I go. So we've got two webinars coming up over the next couple of weeks to flag to your attention. The first is on the 24th of March, where Ken Mayer will be presenting. And then the following week, we're hosting with ShareSoc a webinar for Halma, and all details of those webinars are on the Yellowstone Advisory website. So finally, thank you again to Rahul and Les for presenting, and we look forward to seeing you all soon. Thank you. Bye-bye.
Okay, thank you very much,
you.
and thanks to all for participating. Bye-bye now.